The impact of rating agencies on the banking sector. Rating agencies play a crucial role in the financial ecosystem, especially within the banking sector. Their assessments can affect everything from a bank's ability to raise capital to the interest rates consumers pay on loans. Let's delve into how these agencies impact the banking sector. What are rating agencies? Rating agencies, such as Moody's, Standard & Poor's, and Fitch, evaluate the creditworthiness of institutions and investment products. They assign ratings that indicate the likelihood of default. These ratings are essential for investors seeking to understand the risk associated with a bank's securities. A higher rating typically signifies lower risk, attracting more investors and allowing banks to raise funds more easily. The mechanics of ratings. When rating agencies assess a bank, they consider various factors, including financial health, management quality, economic conditions, and regulatory environment. These factors contribute to the overall rating, conveying the bank's risk level to investors. For example, a bank rated AAA is seen as very low risk, encouraging investment. In contrast, a BBB rating might signal moderate risk, potentially leading to higher borrowing costs. Impact on funding costs. The ratings assigned to banks significantly influence their funding costs. A higher credit rating often leads to lower interest rates on loans and bonds issued by banks. This is crucial, as lower borrowing costs can enhance profitability and allow banks to lend more. Conversely, a downgrade can increase funding costs, forcing banks to pay higher interest rates, which may be passed on to consumers through higher loan rates. Regulatory implications. Regulatory bodies also pay close attention to agency ratings. In many jurisdictions, banks are required to maintain certain ratings to comply with regulations. A downgrade can lead to an array of regulatory repercussions, such as increased capital requirements or restrictions on activities. This creates a self-reinforcing cycle where maintaining a high rating is vital not just for access to capital, but also for operational flexibility. A bank facing downgrades may be forced to take corrective actions, which could include restructuring, selling off assets, or even seeking government aid. Investor behavior. Investors heavily rely on the ratings provided by agencies when making decisions. A bank's rating can influence investor perceptions and behavior, as downgrades may trigger sell-offs or reduced investment interest. This reaction can lead to decreased stock prices and market capitalization, further straining the bank's financial position. Conversely, upgrades can signal confidence, attracting more investment and stabilizing the bank's position in the market. The effect on consumer trust. Ratings also play a role in consumer trust. Many retail customers check the ratings of banks before deciding to open accounts or invest in products. A bank with a strong rating is often viewed as more stable and trustworthy, which can attract more customers. Conversely, a lower rating might generate concern, leading consumers to seek alternatives. The role in financial crises. The influence of rating agencies became painfully clear during the 2008 financial crisis. Many banks held mortgage-backed securities that received high ratings before the crisis, leading investors to underestimate the risks involved. When the truth surfaced, it triggered widespread panic and a loss of confidence in the banking system. This scenario raised questions about the reliability and accountability of rating agencies, leading to calls for reform. As a result, there have been efforts to enhance transparency and reduce conflicts of interest within the rating process, although many challenges remain. Conclusion. Rating agencies exert a profound influence on the banking sector, affecting funding costs, regulatory compliance, investor behavior, and consumer trust. Understanding this dynamic is crucial for banks, investors, and consumers alike. As the financial landscape continues to evolve, the role of these agencies will remain significant, prompting ongoing discussions about their accountability and the methodologies they employ. Want to learn more? Claire Trifle on LinkedIn.